The S&P 500 is taking a breather following a six-day rally that led the index up almost 20% from its April lows. Our next guest says the market pullback provides some buying opportunities and more reasonable valuations than we have seen in a few years. Phoebe Venable, President and CEO Capwealth, joins us now to talk some more about this. Phoebe, thanks for your time today.
Well, thank you for having me.
So
some
say European stocks are going to outperform the U.S. Are you on track with that?
We still have a lot of concern about developed Europe. We've been running the traps on it. We just haven't been able to get comfortable with it. We understand why people would be looking at it. But from our point of view, anytime we go outside of the United States, we're going to put a significant risk premium on the currency exposure that we have. And even with the softening of the dollar, we're still not able to get there under the models and the valuations that we're doing and the way that we look at it. So we continue to stay 100% domestic. I say 100%. We have towed in a little bit into China in the last couple of months as valuation there became attractive. But we're not finding that there's enough premium in developed Europe for us to be comfortable going in there. Our client base is families. We're not investing for institutions. We're investing for families. And we put a high premium on any exposure that we're taking to currencies.
Got it. Now, Moody's, of course, did the downgrade of the U.S. credit rating Friday. We still saw markets rally on Monday. So I'm just wondering what you think is behind this. Are investors ignoring that?
I do think that investors largely ignored it. You know, it wasn't the first time that we've seen the U.S. credit rating get downgraded. And the last time was back in, 2011, 2012 period of time, maybe it was 2012. But the market's up significantly since then. And we, as a investor community, kind of shrugged it off when it happened the first time. But today, the market's been reacting, I think, more to the Moody's downgrade than we saw yesterday. And the reaction that we did see yesterday was mostly in the bond market. We temporarily saw Treasury yields spike. We saw the 30-year go over 5% just briefly yesterday. But I do think that there is more anticipation as we're digesting the Moody's downgrade and we're looking at the fiscal health of our country. I think that there is more anticipation that rates are going to stay higher for longer and that we might be returning to a more normal yield curve.
Talk to me about earnings, because we've seen 8 of the 11 sectors on the S&P 500 have growth, year-over-year growth for the quarter. What do you expect in the upcoming quarters, considering the inflation threat that has to work its way through from the tariffs and other policies?
Well, it definitely is working its way through. We saw Home Depot report this morning, and of course, they said that they're seeing that the consumer is still strong and is still spending. But in other pockets of our economy, we're seeing that, and reporting, we're seeing that consumers are really starting to rein it in. Of course, we saw for Q1 had 3% contraction in our economy, and that's the first time that we've seen that since early 2022. So as the companies are reporting, no one is really wanting to give guidance. No one's really wanting to put a stake in the ground and say that this is how the tariffs are going to impact them, because it's just so uncertain. You know, every day the headlines are changing. We're going from tariffs are 100% to tariffs are 10%, tariffs are paused, tariffs are going to be high on everything except these products. And then the next day, you know, it's a different story. And so as long as we have all of this whiplash from the headlines going on, I don't think that any company can say with any kind of certainty, and the investing public is smart enough to know that there's no certainty around this. So I think that we're just going to continue to see a little bit of back and forth, and this market volatility is going to stay with us until we get some clarity on that.
What are you putting your money into these days? What are the stocks that you like?
So we have been doing some shopping. We have been looking for valuations and looking for things that maybe we have wanted to own over the last few years, but the valuations were just too high for us. Specifically, you know, a lot of people have probably had a way over concentration in technology because they've owned those stocks and they've let them run because of the momentum. Those valuations are coming down now. So if there were names that we wanted to own that that we didn't want to pay that price for. Now might be a good opportunity. But we see great opportunities in the energy sector right now, and energy's got a great path ahead of it. We think that that's a good place to be. So our advice to investors is right now is really not a time to be making big changes to your asset allocation. Switching from stocks to bonds is a strategic thing, but from a tactical perspective, this is a really good time to be making sure that your portfolio is diversified. And so over the last few years of sort of letting your winners run, if that's resulted in a portfolio that has concentrations, now's a good time to be taking profit and buying some of the stocks that you might have wanted to own in sectors that you might not have to round out your diversification. This is also a really good opportunity to harvest some losses and bank those to have them to offset some future gains when the market returns into a bull run again.
Phoebe, I've got to leave the conversation there with you, but thanks for joining us. Phoebe Venable is president and CEO Capwealth. Thanks for your time.
Thank you.
Coming